Today we have a special session with our 1031 exchange expert, James Callejas. So before we get started, before I even introduce James, let's do a little survey for our audience. I wanted to find out if anyone is interested in doing investment, or I'm sure you're interested in doing investment, that's why you're here. But are you interested in doing investment here in California? Or are you interested in doing investments out of state, or you just want to get out of the real estate market? You want to get rid of your investment property and want to get out of the real estate market. Want to do a little survey. So if you wanted to invest in California or reinvest in California, please, I guess you can type 1. And if you're thinking about out of state, you can type 2. If you're thinking about getting out of the real estate market, you can type 3. So kind of know our audience, what you're looking for. And then James is going to share the latest trend of 1031. Great. Thank you, Nick. Nick is thinking about, for the people who are joining us a little bit later, we're thinking, doing a little survey. If you're thinking about doing real estate investment or reinvestment in California, you can press 1. If you're thinking about investing out of state, please type 2. And if you're thinking about investing something else, not real estate anymore, you can type 3. So we kind of understand what you're looking for. So I actually see more 1s than anything else, which is good. 1 means that you want to reinvest in California. 2 means you want to invest out of state. And 3 means you don't want to invest in real estate anymore. You want to get rid of your investment property. So I don't see any 3s at this moment, but anyhow, our little survey shows that most people still thinking, most people from our audience today still thinking about investing in California. Okay, good. Let's get started. Hello, everyone. My name is Coco Tan. I'm with Keller Williams Realty. I've been doing real estate for 23 years, since 2003. So I've been through the ups and downs in this market, and right now I think we have a little soft change of the market. So it's interesting to see how investment properties are doing nowadays. Today we have a special guest. His name is James Callejas. And let me give you his impressive resume. James is the Vice President of National Accounts with Investment Property Exchange Services. He is responsible for business, cultivation, and development nationwide. James has conducted thousands of seminars on different topics related to real estate taxes, estate planning, and personal property. He teaches continuing legal education and continuing professional education to attorneys and CPAs. Very impressive. And I'm sure our audience today have questions on capital gain taxes. If you have more questions on taxes, you can type taxes. If you have questions more about estate planning, you can type estate planning, so that we also kind of understand our audience a little bit better. That way, James can have his focus differently too as well. So let's welcome James.
Great to be here today. Nice to see all of you together collectively on the Zoom. It's interesting, when I looked at all the 1s and 2s, I wonder if the 1s, how many of those own multiple properties, or are they looking to start their purchases in California? Because many times people start in California and then they move to a different area for a number of different reasons, which we'll discuss today. So it was really interesting that you posed that question. I'm glad no one put the number 3. I don't think that is smart. I think it's good to have a diversified portfolio. So maybe you don't put all your eggs in one basket, but you definitely want to keep real estate there for a number of different reasons, whether it be the appreciation, the cash flow, the write-offs, or what have you, or the pride of ownership if it's the primary residence. There's so many different things when it comes to owning real estate. Today, we're going to focus on investment property because we're talking about the 1031 exchange. We're going to talk about trends. We're going to talk about how it works. But I just want everybody to understand that the the 1031 exchange is an internal revenue code that's been around for over 100 years. And back 100 years ago, it was primarily used by farmers who were just selling farms and buying farms. But over the years, and primarily, I'd say after the 70s, it changed into what we see it as today, more than what we saw it as 100 years ago. And there weren't even the strict timeframes back 100 years ago. That only happened in the 70s moving forward. So the 1031 exchange is where you sell a piece of investment property and buy a piece of investment property. And as long as you follow certain guidelines, you'll be in a position to pay absolutely zero in capital gains tax. Now, Coco mentioned capital gains tax, income tax, and just taxes in general. The beautiful thing about the 1031 and taxes in California is we're number one in all those categories. We have the highest tax rates, highest depreciation, highest 1031 count, and it's all correlated. People understand that buying real estate in California, if you've owned it long enough, you're going to make tremendous amounts of money. And the problem with that is if you ever decide to sell, you're going to have to pay a tremendous amount in taxes. As a matter of fact, California at 13.3% at the highest clip is higher than any other state in the country. And many don't have tax or a lot lower taxes, but in California in particular, we're extremely high. So if I were to buy a piece of real estate out here in California and own it for a number of years and have a significant gain, the best case scenario in most sales, I'm going to lose about 30 cents on the dollar. And that's for somebody that really makes almost nothing. The more money you make, the more your taxes will increase when it comes to capital gains tax. You go into different thresholds and you fall into different categories. So if I'm just going to call it a day, make all kinds of money, sell the property, not do a 1031 exchange, and just cash out, and let's say we made $1 million on the property, they're going to hit you four different ways. First, there's the federal tax, and that's either going to be at 15% or at 20%. And after you hit a certain adjusted gross income level, it goes from 15 to 20. If you really make no money, in other words, you're unemployed or what have you and have no sources of income, you might get less than 15%, but only for a certain dollar amount. If you have $1 million gain, that will be short-lived. The majority of that will be hit at 20%, and then a lot of that at 15%. And then you have to deal with the state. And the state will start at 9.3%. It can go to 10, it can go to 11, it can go to 12, and it will end at 13.3% based on how much money you make that year. And a lot of people tell me, well, James, I don't make that much money this year. Well, you just sold the property and you made $1 million. So it is on those gains as well that they calculate how much you're going to be paying in capital gains tax. So we've talked about the feds. That's either 15 or 20%. We've talked about the state. That's either 9 to 13.3%. But then there's also Obamacare, which has been in effect since 2012. If you're a single person and you make more than $200,000 per year, they tack on an additional 3.8%. For a married couple, that threshold is 250,000. So it doesn't go from 200 to 400, it goes to 200 to 250. And a lot of people in the Bay Area already make that. So they're already getting hit with the 3.8%. But if you have large gains, you will eventually hit that number as well. So Obamacare, federal tax, state tax, and then the write-off that we have for investment property, the depreciation that you claim on your Schedule E each year, they recapture 25% of all the depreciation that you've taken. So collectively, at the end of the day, you are probably never going to get out with at least 30% on every dollar. But if you're extremely high net worth or you have a significant gain, you're going to be mid 30s. And in some scenarios where the extremely wealthy just cash out, it could go as high as the low 40s. So California is number one in 1031 exchanges because of the taxes you've seen there and because of the massive appreciation that you see every single day in your backyard. You can ask anybody that bought a property 30 years ago whether or not it's doubled in value, and they're going to say yes in every city in Northern California. And I mentioned Northern California because we're in Northern California, but I got to tell you, it's the same in Southern California. There's a ton out there. It's just California as a whole has massive appreciation. And that's where we come into the 1031 exchange. This is the Internal Revenue Code where you can sell the investment property. Instead of paying all those nasty taxes that I just mentioned, you're allowed to reinvest into other investment property. And as long as you use all of the money and buy of equal or greater value, you'll be in a position to pay absolutely zero in capital gains tax. Now, what I find quite interesting is that when I speak about 1031 exchanges, most people say, oh, so we do the 1031 exchange not to pay the capital gains tax. And I let them know, no, that's not correct. If you don't want to pay the capital gains tax, don't sell the property. People do a 1031 exchange because the property that they currently own no longer makes sense. And that could be for a variety of reasons. If I've owned the property for a long period of time, it probably needs improvements. It probably needs repairs. It probably needs a new roof, the bathrooms, the kitchens, the whatever. There's just so many repairs that have to be done for a property over a number of years. Some people don't like that. If you owned a property for 30 years and it's been investment property, you've probably been a landlord for those 30 years. And I will tell you this, dealing with the tenants, the trash, the toilets, the termites, the taxes, all the terrible T's as a landlord myself, they're not fun. And, I talk to people all the time, and you're going to hear quite often where someone says, oh my God, my tenant was horrible. They never paid the rent. They damaged the property. They broke the lease. I couldn't get them to leave. There was a moratorium because of COVID. They didn't pay the rent. There's so many different things that have happened with this property. It's been like a nightmare. They constantly call me. The neighbors call me. The HOA calls me because they're breaking the rules. You're going to hear all those kinds of scenarios quite often. Then you're going to hear that person that says, hey, James, I don't know what you're talking about. I've got an awesome renter. They've been there for 35 years. They take great care of the property. There's never been an issue with them. Rent's paid on time every single month. It is fantastic. And I'll go back to them. And I guarantee you this happens 90% of the time, maybe even higher. And I'll ask them, I go, well, when's the last time you raised the rent? And then their response is, oh, we don't do that. We have a great tenant. We don't want to lose them. We don't want to get them angry. Well, if you haven't raised the rent or modestly raised the rent in 35 years, you could have been charging $1,000 a month 35 years ago to something that would rent out to $6,000 to $7,000 a month, or maybe even more. And you're going to hear many people out there saying, I have a great piece of investment property. Yeah, when you bought it 35 years ago and you were charging $1,200 a month and the property was worth $230,000, this was an awesome piece of investment property. Now that same property is worth over $2 million. You're charging them maybe $2,000 a month. They've been in the property for years. You're missing out on $4,000 a month in rent. Annualized, that's about 50 grand. We do that over, I don't know, let's just say 15 years. That's a massive amount of monies that you're losing. This is a horrible piece of investment property. And even though the tenants are taking great care of the property, and are they really? They're just not damaging it, right? Because if something goes wrong with the water heater or the furnace, or something goes wrong with some appliance in the property or the roof or anything like that, the landlord's going to be paying for that, not the tenant. So what I'm trying to describe is why people do 1031 exchanges. It's not to avoid the tax. People are tired of being landlords in a tenant-friendly state. People are tired of repairing a property constantly because it was built in 1950, or it was in the city, it was built in 1906. Or people understand that you can only depreciate a residential piece of real estate for 27 and a half years. And after that, that write-off is gone. Or some people understand, yeah, I paid my loan off, so I don't amortize it any longer. I don't build up equity. It's just sitting there, and the return on my investment no longer makes sense. This is why people do 1031 exchanges, to get rid of a property that no longer makes sense into something better. What's better? Well, it depends who we're talking to, right? Some people like better cash flow. Some people like no landlord responsibilities. Some people like being a landlord. So instead of having a single family home that they're renting, they want to buy a 4 unit building, an 8 unit building. They want to have more doors because more doors usually means better income. Some people say to me, you know what, James, all I want to do is sell my investment property and I want to buy a property in Hawaii because I love the islands. I love the weather. I love waking up on the beach. How do we make that happen? And it's real simple. We do the 1031 exchange. We sell the investment property. We do the 1031 exchange. We buy that perfect property. There's plenty of islands out there. You choose the one that you like best and you find a property that's of equal or greater value. You Airbnb it for 1 to 2 years and then you move into it as your primary or have it as your vacation home. So when it's colder over here in the winter months, you can go over to Hawaii or vice versa. And some people say, I'm just done with California. I hate the politics in California. I hate California, period. How do I get out? Well, sell the investment property, do the 1031 exchange, find a state that you like because you got to stay in the United States, buy that property, rent it out initially, whether it's full-time rental or short-term rental, then move into the property. Then sell the primary residence. You have 500,000 of protection if you lived in it 2 out of the last 5 years. And out here in Northern California, many people come back to me and say, it's not enough. 500,000 doesn't even come close. My property's in San Jose. My gain is $1.8 million. 500,000 only covers not even a third of that. So then I tell them, new plan, sell investment property, do 1031 exchange, buy Hawaii property, Airbnb it or rent it out full time for 1 to 2 years, then move into the Hawaii property, then rent out San Jose for 1 to 2 years, then sell San Jose. Now, you still lived in San Jose 2 out of the last 5 years, so you collect the 500,000 and 1031 exchange the rest. And then they come back to me and they say, look, didn't you listen to me? I hated being a landlord. That's why I bought the Hawaii property. And I said, well, didn't you listen to me when I said that there are passive type of investment assets that you can go into, like a syndication? So you could sell San Jose for $2.5 million, take the 500,000 for the exclusion, invest the $2 million into a Delaware statutory trust, spread it out among 3 different asset classes. So multifamily, industrial, and let's call it self-storage, get a 5% cash on cash return on $2 million, no management responsibility, no responsibility whatsoever. And now monthly, you're going to be getting a little over $8,000 per month on the $2 million that you invested into this completely passive asset that gives you all the benefits that you had in real estate. Still get the step up when you pass away. Now you get monthly income on equity that was dormant. You sold your investment property, got out of being a landlord, live in Hawaii now, don't have to worry about this. And by the way, you'll need the extra income because groceries and gas, if you thought they were bad here, are much worse in Hawaii. So you can get all of these different things all through a 1031 exchange when most people thought, you know what? I was selling a single family rental over here and I thought that's what I had to buy and I thought I had to buy it in California. No, you didn't like this property any longer. You told me what you liked. You told me you wanted to get out of California and you didn't want to pay any taxes. Now you sold the investment property, bought the Hawaii property, moved into the Hawaii property, rented out the San Jose property, then sold it so you could still get the 500 exclusion and 1031 exchange the difference into the syndicated passive investment asset. And some of these assets that you get into are absorbed by REITs. So you went into one large asset and now you own operating units in 70 large assets with an increase in cash flow and distributions that you can take after being in it a year. So people do 1031 exchanges for a lot of different reasons. The moment we understand that it's just not about avoiding the capital gains tax, don't get me wrong, that's a great benefit, but that's not why we do it. We do it because the property we currently have doesn't make sense to us any longer. And we want to do something else. Now, there was a bunch of people here that hit number 2. Those people would sell their California property and buy in a different state. They would do a 1031 exchange to move the money. Why? Because they probably hated being landlords, or they wanted better cash flow, or they wanted to buy a dream home somewhere else, or they wanted to get into passive assets, or they wanted to get more doors somewhere else, and they wanted to manage property somewhere else, or maybe they wanted to bring a property closer to where their family lives because their family uprooted and went to Florida years ago or wherever it was. It could be Montana, it could be Colorado, it could be New York. There's many destination places in the United States. You can do this all magically through a 1031 exchange. All you have to do is follow the correct guidelines. And here's the way it works for me. And this is the way I see any 1031 exchange scenario. Now, this is only for investment property. So right off the bat, that eliminates three properties: the primary residence, the second home, and the flipper. Now, on the primary residence, it doesn't qualify for a 1031 exchange, but I just showed you that you can convert it to investment property by renting it for 1 to 2 years and then do a 1031 exchange. And by the way, some primary residences do qualify for a 1031 exchange. The mixed use property, and there's many examples. So if you're talking about Oakland or San Francisco, there are many duplexes, triplexes, 4-unit buildings where they rent out one unit, live in the other unit, or rent out 2 units and live in the other unit. They, in other words, occupy one unit and rent out the other one. So this is mixed use. You have the primary residence for the unit that you live in, and you have the 1031 exchange for the units that you rent. So that's a mixed use example. Another mixed use example, and it's very popular. Let's use San Francisco again as an example. In the Sunset District of San Francisco, I would say about 90 to 95% of the properties out there have in-law units. That's just the way they were built in that area of San Francisco. And I'd say the majority of those are rented out. So when the property is being sold, you can claim the primary residence exclusion on the portion you live in, either the smaller or the larger, and you can 1031 exchange the rental portion. And this is very popular with in-laws, ADUs, casitas, rooms that are rented, home offices. These are all mixed use properties. And when we go to the Central Valley, a lot of farms out there, a lot of farms. These farmers live on the farms and they also have the farm as investment. So it's a mixed use property. There's different scenarios. When we go up north a little bit, right, to Napa and Sonoma County, there's a ton of vineyards out there. And these vineyards, a lot of the time, the people live on the vineyards. So again, primary investment, you can sometimes do both internal revenue codes at the same time, the 250-500 and the 1031. But a primary on its own does not qualify for a 1031 exchange. You'll have to convert it. A second home, on the other hand, qualifies for nothing. Investment, you can 1031. Primary, you can take the exclusion money. Second home, you can pay your taxes. So what many people do, they buy their property in Tahoe in 1985 and they use it for a long time. But the older they get, they just don't make that journey out there any longer. They do not go to Tahoe for the weather. It's too cold in the winter. It's too long of a drive, whatever the reason is. But there's a lot of built up equity. So they convert those properties to rentals, short term, long term, doesn't matter. Then they sell them, do 1031 exchanges and buy a better property for them, whether it's the syndicated property, which is very popular for baby boomers, or whether it's just other properties in other areas for other reasons in the United States. Very popular. But second homes, they don't qualify for anything but paying taxes when you sell them. That's why most people convert them to investment properties. And the third piece of real property that doesn't qualify for a 1031 exchange, flippers. Anybody who buys and fixes a property and looks to sell it into a 1031 exchange, that does not qualify because it was not operated as investment property. What you need to do, buy it, fix it, rent it. How long do you rent it? 1 to 2 years. Why do I say 1 to 2 years? Because it's a gray area. The aggressive tax advisor says 1 year and a day, you're good. The conservative tax advisor says 2 years, you're good. The person in the middle likes to cross 2 tax years. Now, the reason why they say 2 years, there is revenue procedure that supports that. The reason why they say 1 year, the definition of a capital long-term investment is 1 year and 1 day. The reason why some people cross 2 tax years, because it's somewhere right in the middle. But there is no actual time frame. Coco, looks like you have a question.
Right, James, I remember you told us a story before about people owning the Hawaii property for only like a month or so, then started doing another 1031. So it wasn't really 1 year or 2 years.
If there is a good reason, and this is a true story, and Coco remembers it, I had a client. He sold a property in Clayton, California, for $750,000. This was back in '02. He did a 1031 exchange, and he bought a property in Maui. And the property he bought for $1.2 million. So it was equal or greater. It was done. And he put it in the Maui Times. He put it on Craigslist, and he put the big sign out there for rent. And he got a bunch of phone calls. It was a nice property. But then he got this one phone call, and he said, Bob, because that was his name, I don't want to rent the property. I want to buy it. And I want to buy it for $2.5 million. And Bob calls me up, like, I think it was the same day. And he goes, "Hey, can I do another 1031 exchange?" I'm like, "Oh, you got another property to sell?" He's like, "No, no, the Maui property, somebody wants to buy it, but I've only had it for like 2 weeks." And I said, "Well, no, you can't really do that. That's flipping." He goes, "Oh, no, no, no. I was trying to rent it. And this developer came and wanted to buy my property." And I'm like, "Really?" I go, "You didn't put it on the MLS. You didn't solicit it for sale." It's all the opposite. There's paper trail of me trying to rent it. And I go, "Well, then I would do this all day long because this is all about intent. And if your intent was to keep this as investment property and then something
Mhm.
magical happened, like in this scenario, he did a 1031 exchange. He made $1.3 million in, I don't know, it closed in like 2, 3 weeks, in like a month, like Coco said. And he did another 1031 exchange to buy some other property instead of Kaanapali. I think he went to Kapalua and it was, or Napili, one of the two, right on that side of Maui. But the moral to the story is, as a investor or as a realtor or whomever, just ask me, tell me the details, and I will let you know that in many different scenarios, even though that there are guidelines out there, it's all circumstantial in some of those guys. Anything that's gray, I want to hear the story. And when I hear the story, then we can interpret it certain ways. And then I want to get your tax advisor on the phone and let them know, okay, this is what's happening here. These are the reasons why your client may want to consider doing a 1031 exchange. We want to know how you feel because ultimately they need to give us the green or the red light with moving forward. But yeah, Coco, that's a great point. Typically, flippers don't qualify. This was a flip, right? I mean, he turned and burned the property, but it wasn't his intent to do that. It was a unique, unsolicited, beautiful opportunity where the guy made $1.3 million overnight. But when it comes to a 1031 exchange, this is what I like to see most people do. And they don't all do it, but it'd be nice if they did. Okay, we all understand that it's investment property, but sometimes that's confusing and we're not sure if it is or it isn't. Don't try to figure it out. Just call me up. I'll ask the questions. We'll determine whether or not it's investment property to see if it qualifies. That's number one. Number two, I want to know who owns the property. And I know that just sounds simple, like, "Hey, I own the property." Wait, 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 wait. Is it in your name? Is it in a trust? Do you own it with others? Is it in an LLC? Is it an S Corp, a C Corp, a limited partnership? Are you not on title? Is it your spouse's property? I want to figure that out in advance because the taxpayer who owns the property needs to do the 1031 exchange. So we need to figure out and make sure everything is lined up properly. And then the third thing that you want to do is figure out what you want to buy. And I'll explain why. But before you list the property, you may not have to figure out the exact property. But if you say, "You know what? I love the Hawaii story, and I don't like people. So I think Lanai or Molokini or maybe even Kauai, depending upon where we go, is where I would like to consider property." So my plan is to choose one of those islands. Let's start looking for inventory in advance to see how difficult and challenging this will be. And if it gets really hard, then we'll just have to go to the big island. But I'm not going to Maui or in no way Oahu, right? So like we figured these plans out in advance so Coco can do her magical thing that she does and help or refer out other. I know that there's K-Dub all over the world and in the United States, so she can help make the connections where you will be able to not only sell the property over here, but at the same time simultaneously looking for the exit strategy so that there is no risk of failure. Because here's how it works. We have the conversation. We determine it qualifies. We figure out who owns it. We know what the battle plan is to buy the replacement property. Then the property is listed for sale. Once an offer is accepted, you open up escrow. Out here on the East Coast, it's attorneys that close it, but let's just talk Northern California. Open up escrow, then call me up right away and let me know because I am a qualified intermediary. I am a 1031 exchange company. I am an accommodator. Those are all synonymous. They all mean the same thing. But we are needed when somebody is going to do a 1031 exchange because the seller can't touch the money. So we need to be involved prior to the close of escrow, and the sooner the better, so we can review the title report and contract. Those are the two items that we will need. We'll need a copy of the title report because it'll show the vested owner of the property. And usually those are correct unless they haven't been updated. For the most part, they're correct. And we'll need to get a copy of the contract because we assign into the rights of the contract and we act as the seller. So we'll create a 1031 exchange account. We'll create the legal documents. We'll send it out to the seller. We'll send it out to escrow. Escrow will review their instructions and revise them. The seller will sign our paperwork. We'll set up the account. And at the close of escrow, the proceeds from the sale, after the closing costs are paid, after any loans that are on the property are paid off, will go into the 1031 exchange account. That is day one. You have a total of 45 days to identify replacement property, and you need to buy of equal or greater value to what you sold to pay no tax. So let's look at that. Let's say we were selling a San Jose property for $2 million. And let's say that there was a loan on there for $1 million. The loan gets paid off at the close. Let's not look at closing costs because that'll just make the numbers a little bit uneven. So let's not look at them, even though we know they exist. Sell for $2 million, pay off the loan. $1 million goes into the 1031 exchange account. That is day one. And we have 45 days to identify what we're going to buy. And some people say, oh, okay, I have $1 million in the account. I need $1 million property to buy. No, that is not the case. Your target price is $2 million. Right, but I only have $1 million. And not even that. I bought the property for $600,000. My gain's only $1.4 million. I should only need to reinvest the gain. When it comes to a 1031 exchange, you don't just reinvest the gain. You don't just reinvest the equity. You buy of equal or greater to what is sold to pay no tax. Now, people say, why am I going to do that? Am I going to pay tax on the whole $2 million? No, if you cash out, you only pay taxes on the gain. So even though if you were to cash out, you would pay tax only on the gain, you have to buy of equal or greater value to what was sold to pay nothing in taxes. Now, if you buy of less value, still works, but you pay tax on the difference. Most people don't want to do that because like I mentioned earlier, tax rates are extremely high. So again, we have our plan set up, escrow closed, we paid off the $1 million loan. Now we have 45 days to identify potential like-kind replacement property. So we sold a single-family home in San Jose. It was a rental property for 25 years, more than qualifies, massive appreciation, and they want to do a 1031 exchange to buy replacement property. Now, you can buy any real property in the United States as long as it's used for a business or investment purpose. So even though I sold a single-family home that's a rental, I could buy bare land. I could buy farmland. I could buy vineyard land. I could buy a condo that I rent, townhouse that I rent, single family home rent that I rent, duplex, triplex, 4 unit, 10 unit, 30 unit, 100 unit, industrial building, office building, motel, hotel, retail shopping mall, oil and mineral rights, billboards, windmills, air rights. There are a lot of things that you can buy in a 1031 exchange. I even explained to you guys how you can buy the primary and second home in a 1031 exchange. You just got to rent them out first in most scenarios. Coco, you had a question.
Yeah, so the bare land, what are you going to do with the bare land? You have to rent it out in order to qualify.
That's a great question. I've had people, not often, that just let it sit and let it depreciate. I don't like that plan. I like cash flow plan. And sometimes bare land can be considered agricultural land, so they might have farming done on there. They might let cattle graze there, but a lot of people buy the bare land to build on it. And their 1031 exchange, they sell a property, let's call it, I don't know, Hayward for $600,000 and buy a huge lot of land that's worth about the same, and they complete their exchange, and then they eventually build their primary residence on it, or they build something that they're going to rent out on it. So we do have people that do buy the land and they develop the land later and make it part of their 1031 exchange. They have people that sit on the land and it appreciates in value. There is actually 3 companies that I know of that just sell land.
Or they
But
can buy fix uppers, like they can
yeah,
even buy fix uppers.
they could buy. So we'll get into that because I think that's a component that we definitely need to touch. But just understand this. If there's any confusion, if there is a plan that you're looking to entertain, ask me in advance. I'll let you know if it works and how it works. But most people out there have no idea that I could sell a single family home rental and buy a 1% fractional interest in a 450 apartment complex that was built in 2024 in Charleston, South Carolina. They don't know that I can buy a fractional interest in that big building. They don't know that I could go buy a Holiday Inn in the Central Valley. They don't know that I can do these things. But in a 1031 exchange, tell me the plan. Because, like I said, people are selling these properties because they don't make sense. I deal with so many people in the Bay Area that sell condos because all of a sudden the HOAs have gone up astronomically, or there's like a new balcony requirement in Berkeley, and like they're making you contribute all kinds of monies and get things approved. I mean, that's just one example, right? There's many different examples why people want to unload, but they don't know what to get into. Tell us what you like. We'll tell you what's available, and you go into that as a possible solution. Now, you have 45 days to identify in writing to me, and you are limited to the number of properties that you can identify. And that's why it's critical that we have the conversations in advance. Coco, you had a question.
Yeah, so basically you're saying if I have a fix up or if it's a project, I cannot use that as a 1031. However,
Yes and no.
uh,
So there is something called an improvement exchange where I can sell my single family home, buy, let's say we buy a total fixer upper at $1.2 million. Got a target price of $2 million. I could use the $800,000 to improve the property through a 1031 exchange. Now, the challenge with those types of properties is, number one, I have to identify the improvements that I'm going to do in the 45-day window, and they have to be completed by day 180. So in certain areas, permit wise, that's going to be incredibly difficult. But in certain areas, I can definitely use a lot of money in those timeframes. Put a pool, put a roof, fix the bathrooms, fix the kitchens, do all kind of foundation work, whatever. There are many scenarios where I can use the money to improve the property. It's a different type of 1031 exchange that is popular, but is challenging because you have a limited time frame to get it done. But Coco, I think what you were alluding to, and I just went into a different direction, is number one, we can use the money to improve the property. But number two, you can't just sell it. You got to rent it for at least a year.
okay.
You can't be
So,
flipping
so
properties.
basically, once you flip, that flipping property cannot be a departure property, but you
No.
can use a flipping property as a the new acquisition, and
Yeah,
then
it could be the
you
new
rent out that,
acquisition, fix it up, then you gotta rent it. Yeah, that's the
right?
challenge. Because well, here's what the flippers do. After, if they've done enough flips per the year, they're like, look, I just don't want to pay the taxes again on this. I'm going to flip about 8 of these, and this ninth one, I'm going to keep it. And I'm going to keep it as a rental for a year or two. And then I'm going to 1031 exchange and do the same thing, buy a bunch, keep one as a rental to satisfy my exchange. So, I mean, there's many different scenarios. The flippers, the ones that specialize in turning and burning, they do call me quite often, and they strategically use the 1031 when needed. And I let them know. And for those people, I tell them to be very conservative, because if you do it for a living and you get audited, I think your defense would be horrible.
Mhm.
So 45 days to identify, got to identify the like kind property. But most importantly, you're limited on the number of properties that you can identify. You can choose one of three rules. The first rule is called the three property rule. This rule allows you to identify up to three properties of any value. That means I don't have to identify three. That's just the max, but there's no limit. I sell San Jose for $2 million. I could identify a property that's worth $1 billion. I'm not going to do that, but there's no limit is what I'm trying to say. So you have the ability to identify three properties. That's the limit, but no limit on the value. But many people say, look, I'm leaving California. And if I sell for 2 million out here and I go to Texas, and in certain parts of Texas, I reckon you could buy a lot for $2 million. Those people, they use the 200% rule. The 200% is as follows. You sold the property for 2 million. So you just look at the gross sales price or whatever you sold the relinquished property for, you multiply it by 2, so you sold it for 2 million. 200% of 2 million is 4 million. You can identify a total of $4 million worth of real estate. So if you're identifying $400,000 properties, you could identify 10 of them. Now you only got to buy 5 to get to equal or greater value, but you may want to buy the whole 10. But the idea is the 200% rule is used for the investor that's looking to buy a lot of smaller properties, usually leaving California, going to a different state. And then the third rule, and this one, look, this is year 28 of me doing this, and I've helped 55,000 investors complete exchanges. I've seen this rule work about 9 times. This rule is called the 95% exception. It says you can identify as many properties as you want, no limit on the value. However, you need to close on 95% of the value that you identify, or the entire exchange fails. If you need to use this rule, I will let you know. You're probably going to be using, more than likely, guaranteed you're going to be using either the 3 property rule or the 200% rule. You're going to be identifying like-kind property. You're going to be buying of equal or greater value, and you're going to close on these properties within 180 days. And so the way the time frame works, I told you day 1 is the close, 45 days to identify. From day 45, you have an additional 135 days to close on what you identify. So the whole thing is 180 days. It's not 180 plus 45. It's a total of 180. So it's the 45 plus an additional 135 days to close on what you identify. And if you do things properly, like plan it out in advance, ideally you're closing right away. Now, certain scenarios like commercial property is a longer due diligence process, or if you're buying new construction, which I love, I could put a deposit on a property right now and they haven't even started to build it. And I could strategically list my property for sale when I know that the project is going to be completed within my 180-day time frame. So I already secured my replacement property. I'm just waiting for the right time to list my property, because I know if I list my property for the right price out here, it will sell. It's still the Bay Area. It still goes when it's priced correctly. So again, the 1031 exchange, all about timing, all about planning, all about having the right team. And then some people come up to me and say, look, dude, I don't know. Here's what I want to do. I want to buy that beautiful property in the Mission Hills of Fremont, and there's just no inventory for what I want. So if I'm trying to find something within the 45-day window, I think my chances of success are about 30%. I can't take that chances with my huge tax liability. And for that person that's looking for particular properties where there isn't much inventory, I think the reverse exchange is very powerful. Now, the reverse exchange is where you buy first and sell second. And this happens, number one, in again, the state of California, just because limited supply and large demand for specific properties. So people do the reverse exchange where they buy first. Now, here's how it works. They get into contract to buy the property and we get involved right away. As a matter of fact, we have conversations before they even do this. But the way it would work is they get in contract, they contact me, we put together the legal documents, but we do a little bit more than that. We also set up an LLC that will go on title to the property that they're looking to buy at the close of escrow. The reason why we do that is because the owner of the relinquished property cannot be on title to the replacement property at the same time, can't own both at the same time. So they will bring in the money. We will set up the entity. That's the LLC. The LLC will go on title at the close. And from that close date, they will have 180 days to sell their relinquished property. Now, the easiest way to get a reverse exchange done, I got to be honest, is cash. But not everybody has $2 million, $3 million in cash. The ones that do it simple, they bring the cash into escrow, it closes in the name of the LLC. Then they have 180 days to sell their property. Let's say they sell it in 60. The cash from the sale property goes to pay back the monies that they came in with to buy the replacement property, and their exchange is over. They can take over the LLC or put it back into their names. It's up to them. But the idea is they bought first. They don't have to worry about the 45-day window. They sold their property. They paid themselves back with the cash that's sold from the relinquished property. But not everybody outside of Coco has that kind of cash to buy the property first. And if you
That's
don't have
funny.
the and if they don't have the cash to buy the property first, then you have to get financing of some sort. And financing in a reverse exchange for residential property in particular is more challenging because conventional lenders typically do not lend to LLCs. So now you're talking private money, you're talking points, you're probably talking 2 to 3 points. So that's, two to three thousand on every $100,000 in fees. So the fees for something like that could be astronomical. If the seller is willing to carry, that's awesome. That solves all the problems. If you have the cash, that's easy. If you can borrow through other means, sometimes people do HELOCs, bridge loans, margin accounts or other means, then that will work. Otherwise, it's not an option. If you can't come up with the money to buy it first, it doesn't work. But it's a great solution for people in the Bay Area with the equity position to do so. And it solves a lot of these problems of trying to find the ideal property in the 45-day window, especially when you're looking for specific properties. Now, I told Coco today that I was going to talk about some of the trends that we're seeing out there in 1031 land. And I got to tell you, I'd say the biggest trends that we're seeing, there's three of them. Number one, and this is for California sales. Most of the California sales that we're seeing for baby boomers, they're going into the passive investment world. So they're going into the Delaware Statutory Trust. They're owning fractional interest in large commercial institutional assets. They have no day-to-day management responsibilities whatsoever, and they're getting paid monthly. So whether it's the Delaware Statutory Trust, where you own fractional interest in this large commercial institution that will probably be sold in 5 to 7 years, and you'll do it again, or it's the REIT that you buy into. Now, the REIT, you go through the DST. So here's how the REIT works in a 1031 exchange. The REIT is a real estate investment trust. And so it's like a bunch of institutional properties in this one big fund, this REIT. And to sell a single family home and buy into a REIT doesn't qualify. A REIT's a security, and a single family home that's being rented is real property. But the way it can work is you sell the single family home, you do the 1031 exchange, and you go into the DST. These DSTs that you're going into are on a schedule to be absorbed by the REIT in 2 years. So you initially buy into the DST, you own that 1% in that large multifamily property, and that property is going to be absorbed by a REIT in 2 years. And now you're owning operating units, no longer real property, and a multi-billion-dollar privately held REIT that's comprised of many, probably around 50 to 70 other institutional assets. Sometimes it's different product types. Sometimes it's a mix of product types. What I mean by product types, it could be industrial properties, it could be office properties, retail, multifamily, self-storage, student housing, senior housing. There's many examples out there. But the idea is I no longer manage real estate. I no longer own real property. My property's in a REIT. I can take distributions out of that REIT after being in the REIT for a year. So I could take distributions, and some of them are tax-free up to a certain number, your adjusted basis. There's many, many, many different advantages of it. And I still get the step up in basis, right? When you pass away in real estate, I bought it for 100 many years ago and I sold it for $1 million, $900,000 gain. Well, if you pass away, that $100,000 basis is stepped up to current value, $1 million. Beneficiaries inherit, sell the property, no capital gains tax due. You can do that in the DST, in the REIT, in any real estate asset that you buy into. So that's one. So the passive investment asset is a trend that is extremely popular. I'd say it might be north of 25% of our clients are doing this. Another trend that we're seeing is the parents, I kid you not, the parents are buying properties for their kids in 1031 exchanges. So I have a client that recently sold a 4-unit building in San Francisco for about $3 million. And they called me up and said, "Hey, James, we don't want to buy another property. We want to buy primary residences for our kids. Can we do that?" And I said, "Yes, you can do that. How do we do that?" I go, "Okay, well, you have a target price of 3 million. So I don't know if you're going to split it up evenly, but if you are, which they were, it would be $1.5 million to each kid. And you said kid A wanted to buy a property in Tiburon. Um, you're not going to get a property in Tiburon for $1.5 million.
No.
And they said, "We understand that." They're willing to buy the difference. And well, perfect, because that works as well. So what happens, and we'll make the numbers easy because this is not the true number, but this is a true story. The Tiburon property, let's just call it $3 million. So parents come in with $1.5 million in cash. Kids bring in the rest, whether it's cash or financing, both ways work, and they own it as tenants in common 50-50. Market value rent for that particular property was $8,000 a month. So kids on that property, we're paying mom and dad $4,000 a month because they own 50% and market value rent was 50% of 8 grand, which is 4 grand. So they created a lease agreement. Mom and dad depreciated, collected the income, paid taxes on the income. Done. That's property number one. Kids move into it as a primary residence day one. Property number two, Danville. Same story. You're not going to get a good property in Danville for $1.5 million. They, let's say it again, even though it was a little bit less, let's say it was 3 million. Same thing. Tenants in common, owners, and they charge rent to the kids. And after 1 to 2 years, and when it's the kids to parents, I'd recommend probably 2 years to be conservative. They don't even have to pay rent anymore. So what the parents did is they essentially bought their kids' primary residences. They also amended the trust to put provisions within the trust that kid A was going to inherit Tiburon and kid B was going to inherit Danville, so that when parents pass, there is no fights about, well, I get part of this and you get part of that. Coco, go ahead.
Yeah, question. So the vesting has to be exactly the same. How does it work if it's going to be parent and kid tenants in common? So the original vesting wasn't tenants in common. So now,
Doesn't matter. The vesting will remain the same because parents owned it in their trust. They're going to buy their owner interest in the next property in their trust. You can always buy with other investors as tenants in common. So their vesting remains the same.
the
They
vesting is
just,
going to be living trust, basically.
yeah, they're going to still own it in their living trust as a tenant in common with the kids.
That's the tricky part because if it's the parents' community property with right of survivorship, when they buy the next property, it can only be the parents' name community property with rights of survivorship. So it has to be in the living trust, right?
Um, I've seen it many different ways. What has to remain consistent is that they buy of equal or greater value into the next property. Just like a DST, you're not buying that 400 million or that no, you're not buying that $120 million property by yourself. You're buying it with others as tenants in common. Everybody has their own fractional interest. So I'm buying the property with my children and I'm owning it as a tenant in common. My wife and I happen to have it in our trust, but if it was in our individual names, it would still work. It would be James and Angie Callejas on title for 50% or whatever the percent. It doesn't even have to be 50-50. I just use those numbers. It could be 70-30, 80-20. It doesn't matter. What matters is that we buy of equal or greater value, that we own it in the same vesting, which would remain the same. It would be our trust. And then they would own it as the other investor, as a tenant in common with however they hold title in their trust, their individual names, their LLC. It doesn't matter. It's as tenants in common. It works.
Oh, so basically, whatever title for the departure property, you're not moving 100% exact the same title into the acquisition property.
Your title is going to remain the same. You're just not going to own 100% of the property.
I see. So you
For
have,
your ownership interest, you will own your ownership interest in that entity.
so
That's a Joyce
yeah.
Tran has a question. That's a question for the lender. Um, we've done deals where they're both on the loan. We've done deals where only the kids were on the loan. I don't know how they make that happen, Joyce, but there's something that's called an equity shared agreement that's put together with the children and parents on transactions like this as well to make it more ironclad. But in terms of the lender, I can't answer that question. I could just let you know that this happens quite often.
So it can be done with the conventional lender, you're saying, right?
I have not seen a problem with that.
I can.
Now, sometimes there is a problem with getting an owner occupied rate, though. So even though the kids are going to live there, when they find out it's coming from 1031 money, they're going to give them more often than not non-owner occupied
But
financing.
it is tenants in common. So whatever percentage for the parents' part is investment, and whatever percentage of the kids' part is owner occupied.
Correct. And I mean, this is where it's really crazy. I've seen it where the kids own 80% of the property, parents own 20.
So
Parents are bringing the
that can
huge
be a
money.
primary home own loan, right?
And most lenders will not give owner occupied financing because they know that 1031 money is coming in there,
I
even though they're living there. Even when it's a primary residence on a duplex, they won't do it either. Rent out one unit, live in the other. They won't give owner occupied financing.
will. They will.
Um,
If there's
uh,
owner
let me
occupied,
let me correct myself. Not all lenders, and it really depends on the lender because some have done it and some have not done it. I can't explain what underwriters say they can or can't do. But to me, if somebody is living there and they're on title, they should get owner occupied financing. But I don't make that call. So that's out of my expertise. I've seen both.
Yeah, so from 1 to 4 units for those multi-unit, 1 to 4 unit, as long as the one unit is owner unit, you can get primary home lender rate. Yeah.
If the money is coming from a 1031 to buy the 4 unit building,
Then that's different.
that's different, but that's all we're talking about. See, I know what you're saying. If I buy a 4 unit and I'm living in it from the start, not a 1031, yeah, I can get owner occupied.
Right.
But if it's 1031 money coming to buy the owner occupied, to buy the fourplex and I'm living in 1 unit, I doubt they'll give you owner occupied because once they hear the word 1031, the underwriters just get really scared
Automatically. Yeah,
automatically.
automatically.
Even if the majority is primary, they still do that. And then they ask me to write a letter saying it's okay. And I tell them I can't do that.
The majority is actually defined by the parents. It wasn't defined based on down payment, based on the contribution, right? So even if the parents can be contributing 80%, but the kids can own 80%. Does that make sense?
Right. But I've seen scenarios where the parents sell a property for 500,000 and they buy a property with the kids for 2 million and the kids own 75% and the parents own just the 25% and that money is used a lot for down payment. The lender still will not give owner occupied financing,
I
even though, and again, I can't explain it, Coco. I'm not a lender, but that's where you probably have to talk to a few, Joyce, to see if you can get the owner occupied financing. What I have learned is a lot of people just do non-owner occupied and then later on they refinance to owner occupied financing.
But my question is different. I think maybe I have a title person here. My question is, if the parents contributing 1.5 million to the purchase and the kids only contributing $500,000, can the kids be owning the property 80%, but the parents owning 20%? That's the question. Do I have a title
I
person
that
here?
sounds like a gift. I can't imagine that working because their contribution is 75%.
I see. So you're saying it's only based on the contribution, right? But
Yeah, on the contribution and how much they're responsible of the loan, if at all. Because if it's not an all cash sale and there's financing, then the parents would have to replace the financing, and sometimes the loan is shared. But if it is just an all contribution cash, then the numbers that the tick percentage should be predicated on the amount that was contributed.
got it. Okay.
Co
Rachel,
Oh,
Coco, you do have a title person. I'm right here.
yay.
Richard Chen in the house, my
Hey,
friend.
hey, however, we as a title company, we don't really care, uh, who brings in how much money. We don't really care. That's really a tax question. How you want to, take care of that in terms of capital gain or whatever in the future consideration. Title company, even the parents bring 80% of money, claiming on 20% of the share. Title company doesn't have an issue with it. It's
It's more of
really
a gift money issue. Basically, it's
We
not a title issue.
right,
we would have an issue with it. So title's not going to care as much,
right.
but for 1031 purposes, the numbers aren't going to they're not going to pencil. That would like if parents came in with 1.5 million and kids came in with 500 and kids own 80 to 20, it's like no, that's way off. That can't happen because parents have to own 75% or else it messes up their exchange.
Gotcha.
That, that is why this is so great that we have James right here because Tyler wouldn't know anything about this. That's why you have a good tenant exchange expert there helping you. Thank you,
Wonderful.
James.
You're welcome.
Thank you, Richard. Yeah,
And
so I want our audience to speak up with your questions. I even know James, you have a client in the audience, Mr. Tong Gao. I think he has a question for you, but Mr. Gao, you want to speak up?
yeah, please.
Uh, I don't know what question. So basically, what I'm thinking is selling a property in San Jose, then go to some places like Las Vegas, buy a replacement property.
Yeah. We
I
have
think
many
I know. I think
clients.
I know his question.
So if it's less than,
The
yeah,
value.
okay. So let's say if I sell the house, let's say for 600K, then there's like closing fees and the cost of those things. It's let's say $50,000. So I only have the 50K deposit into the 1031. And if I buy a replacement property, let's say less than that amount.
You'd pay tax on the difference. So let's say you sold San Jose and after closing costs, you have 550 and you bought something in Vegas for 475, then
Yes.
that 75,000, either you would buy a secondary property or pay tax on it. Either way, they
Okay.
both work. So
So, my
it's not an issue.
yeah, so my question is like when I first bought the property, let's say I spent $200,000. So on the $75,000, that's still less than the principal I paid upfront. Why should I pay tax on it? So the tax is not calculated on
No. So the
the
way it
cash.
works, and this is where you have to take logic out of the equation. The IRS will say any money that you do not replace, any money that you keep, any difference that you buy down, that money will be treated as gain money first, not original purchase price or money put into the property. And I know it sounds unfair, and I agree with you. And you could try to call the IRS and tell them that it's unfair. They don't care. Unfortunately, any money that you keep, they're looking at that as gain money first.
But
I
James, I remember, if he sells for 600,000, if there is closing cost, I remember you can take
Those
out the
those are
closing
those
cost.
are the, and he took those out though.
So
He
five
said
fifty, 550.
550, right? Because you could
That's
take
the
out.
value, right?
Yeah, that's the value. So if I sell for any amount, there's usually real estate commissions unless it's a for sale by owner, but that's rare. So let's call real estate commissions 5%. Let's call everything else 1%. Let's call that 6% total. 6% off of 60 or 600,000 is what, 40 or $36,000 in closing costs. Whatever the closing costs are, we can look at an estimated closing statement that Richard could give to us, and we would take those fees off, and I could give you the estimated amount. We were just giving an example of 50,000 in closing cost, which is a little high for a $600,000 sale. Um, but the target price would be 550 using those numbers. And if you bought something of less than the taxable portion would be the difference unless a secondary property was bought.
Mhm.
And I know the argument is, well, wait a minute, if I bought it for 200,000, why am I paying taxes on 75? We didn't cross the 200. Well, because I told you not to look at it logically. The IRS says any money kept, they're going to look at that as gain money first. It's all in the same pool.
So
I got
he
it. Yeah, thank you. So don't basically don't try to reason with the IIS. That's what.
No, it doesn't work, to be honest. It just doesn't. There was a question that came up earlier. We could do a 1031 exchange in any state. It doesn't have to be selling in California. I have done every single state in almost every U.S. territory. I haven't done the Northern Mariana Islands, so if anybody here wants to exchange into it or out of it, please let me know. It would be my first, but I've done the U.S. Virgin Islands, I've done Guam, I've done America Samoa, and I've done every state in the United States. So I forgot who asked that question, but yes, it doesn't matter where the property is being sold, we can handle it.
So going back to Mr. Gao's question, so if he actually sold the property for 600,000 minus the closing cost 50,000, so he just need to buy something 550 or more. But if he didn't buy 550 or more, if he buys something for 500,000, for the 50,000 that he's short, does not disqualify him from the 1031, right? It does not
No,
disqualify. He
no,
still qualified for the 1031, except that he has to pay the difference
right.
for he has to
He'll,
pay tax on the 50,000.
he'll have a tax consequence on the 50,000, and who knows, he may have losses in his portfolio that year that will offset that gain or expenses to the property or whatever. So the 50,000 on the surface looks taxable. Talk to the tax advisor to make sure whether or not he does or doesn't have something to offset. Our fee is $1,000 for the property being sold and $250 for each property being acquired. That's for a regular exchange, a reverse exchange, or improvement exchange is usually $7,000 to $8,000. You mentioned earlier 8,000 a month on 2 million 1031 exchange into a DSC. How does the math work? I mentioned that for the Danville rental property. Um, oh, I did mention that for the 2 million. Oh, 5%. of the 5% return on the $2 million is roughly 100,000 per year. If you divide that by 12, that's a little bit over $8,000 a month. That makes sense? You're coming in with $2 million of equity. You're getting a 5% cash on cash return monthly. It's a little bit more than 8,000, but not much.
Great. Any other questions? Feel free to speak up or type in the chat. Yeah.
It's the same process. You'll list your property for sale out of state, and at the same time, you're looking for property in California. We have people that do that all the time. I just said that the trends are leaving California, but for every five that leave California, two come in. It's not that people are not buying property in California, but the idea and the reason why I mentioned is because we make so much money on the property out here when you've owned it for a long time. That's why they leave California to get better cash flow. But it's the same process. You talk to Coco and say, hey, I want properties in Milpitas and Fremont and San Jose and Santa Clara and Campbell or whatever, or go crazy, Los Gatos or whatever to find properties, and she'll start letting you know what's available inventory wise and price range wise, and you'll sell your property and let me know when it's in contract and we'll set it up, and you'll just make things happen within the time frames. Whether you leave California and go somewhere else or leave somewhere else and come to California, it's the same process.
Actually, our initial survey was done in the beginning of the seminar. Most people actually buying or reinvesting in California. Only had a couple of people saying we're going out of the states, right? So California is
Yeah.
a good place to
Can
invest.
I answer a question?
Yeah.
This
Yes.
is Eva, Coco, and James. I I think I heard the answer, but just want to confirm. So exchange cannot be done with out of United States property.
Correct. So if you are selling domestic property, you have to buy domestic property. The only way out of the country would be for the U.S. territories, but that's not really out of the country. And all of them qualify except for Puerto Rico. So
Okay.
Guam, U.S. Virgin Islands, America, Samoa, and Northern Mariana Islands work. Puerto Rico does
Okay.
not, but you cannot leave the country. People can do international 1031 exchanges. So if I were to sell um,
Mm,
in Beijing and want to go to Hong Kong or whatever, I could do
mm,
that, or Melbourne to Sydney. I mean, if we're staying in same countries, and you
mhm,
can go different countries as well.
Is that right?
mhm.
You can actually do overseas properties. I thought 1031 is for it's a US tax code, right?
No, there's international trades. We just don't do them at IPX.
But it can the 1031 can be done with international properties.
Yeah, I've never done them, but yes, they can.
Okay, and
Oh,
it can only be international to international.
Right. You can't sell in Europe and buy in the United States. It's United States, it's domestic for domestic, international for international.
But when you say
oh,
international, can it be Europe to China or it just has to be within
So
China?
I've been told, Coco, I've just never done them to actually give you the yay or nay, but yeah, I've been told that you can. I think that there would probably be withholding from country to country, but I'm really not positive.
So most likely within the country.
That's what my thought process is, but I've been told differently. I just don't know, to be honest, because
Okay.
yeah.
I don't deal with them. Sam had a
Thank
question.
you.
No problem. If you have more questions, just let us know. 500K loan with $2 million rental. If we buy 1.5, how does the tax work? You'll pay tax on the 500. Whether it's a loan or cash, you're still going to pay tax on it as long as your basis is under 1.5 million. You'll still get a benefit from the exchange, but you're going to pay tax on the entire 500.
Because the base is based on the sold price. Yeah.
Kathy Wang says, for the 45-day rule, can I close the next property before I sell my current one? Only in a reverse exchange, or get into contract first. That works. Just can't close on it for the next one ahead of my current property. Yeah, that's popular.
Yes.
As long
That's
as
a good
as
idea.
long as the seller of that property is willing to wait till you close your relinquished property, either a contingent sale, a long escrow, a new constructed property that's going to take a while to be built. You could always be in contract to buy your property today, not even close for 3 years. As long as the one that you're selling closes first, it works. Otherwise, we have to set up a reverse exchange.
We have done that actually just do almost simultaneously. You just have to closing the current sale first, and you can
Yeah.
close the purchase
And
right after. Yeah.
And to answer Yoon's question, we're a national company. I can do a 1031 exchange in any state. We have offices in almost every single state. Not in Alaska, no office there, but we do 1031 exchanges in Alaska. Our fee is $1,000 on the sale, $250 for the purchase, and the reverse and improvement exchange are $7,000 to $8,000 unless they're commercial. Commercial, I have to get more details, but for residential property, $7,000 to $8,000.
For reverse only. So
For
the
reverse only.
the
So
regular,
regular, if you're selling first and buying seconds, $1,000 on the sale, $250 for the purchase. The consultation, my consultation, sadly, is complimentary. But if you want to pay me, Josh, or anyone else, not just Josh, you can. Nobody's taking me up on that.
it's a free consultation today. Thank you so much for your time, James.
It's always a free consultation, unfortunately.
All
I
right.
had one really quick question. So,
Okay.
if let's say I had a property in Texas and I'm doing a 1031, selling the property in Texas into California, I would have a qualified intermediary in Texas. Do I need to get a qualified intermediary to handle the funds
No,
in
you'll have a
Cal?
qualified intermediary, just one.
Okay,
We can do it. If you're selling in Texas, I do a lot of Texas transactions. You do not need a Texas qualified intermediary. You can use one, but you could also use me if you wanted me to handle a sale. I've done 1031 exchanges in every single state. So whether it's
got it.
not just for the buy, it's also for the sell.
Right.
So either way, but if you have somebody out there, you're not going to need somebody out here to answer your
Understood.
question.
Okay, sounds good. Thank you so much for doing this. This is very informative and
My
productive.
pleasure.
Thank you.
We do this
Thank you,
every year.
Coco.
You guys
Yeah.
got to show up more often.
Yeah.
My contact info, Coco, do you want to share that with everybody, or do you want me to put it in the chat, or?
Yeah, you can either do that, or I'm going to email out to everybody. So I can,
Coco's going to email out to everybody, but I'm going to put my email address in the chat, and I'm going to put my cell phone number after that. If you guys want to contact me with questions,
I put my email there too. So you have any questions, or if you want a recording, if you want to, can you hear me? I get stuck. Can you guys hear me?
Coco, we can hear you, but we cannot hear
or
James.
say something.
Okay,
Oh,
now I
there
can
she
hear you.
goes. You're
I
back.
got so worried. Okay, so I can have a recording to anybody who came in late. So just email me, and then we can go from there. I can also put my phone number if you're interested in asking any questions. And if any topics you guys wish to hear, feel free to type in, and then we can do this. And I found it's actually pretty relaxing when I have a speaker. I can just sit here and listen and learn, and I don't have to do much preparation. So any topics you guys want to hear, you can feel free typing, and I can always have James come back for the other aspects of 1031 exchange, because there are so many things that we haven't even covered today. So, but thank you so much, James, for your time.
You're welcome.
And
Okay, everyone. Then everyone have a great evening. I look forward to helping all of you. Rental tax in the future, I don't know, Yoon. Not my field. But I'm sure we'll hear about it soon. Just go out there and vote to make sure that bad things don't happen.
vote. Got it. Okay, we need a CPA for our seminar.
Correct.
Yeah.
All right.
Thank you
gonna
so much,
take off.
everyone.
Thank
Yeah.
you, Coco. Have a
Thank
good
you.
one,
Have a
everyone.
good night. We'll
Okay.
see you next time. Okay.
See
Bye
ya.
bye.
Bye-bye.
Thank you.
Thank you. Bye bye.